Excellent. Okay, great. I know it's getting towards the end of the day, so I'll keep this brief. You're going to see more of me, I believe, on some panels also afterwards. So just first, I've been coming to Oslo Blockchain Day since it was started in 2016. This is my third. I missed last year. But previously, I was wearing an academic hat only, and now I'm wearing an industry hat. I, a year ago, joined Blockchain.com, which is one of the world's oldest cryptocurrency companies, started in 2011, best known for our wallet, 35 million users, not all uniques. Some people have more than one wallet, of course. Also our blockchain explorer for Bitcoin and now Ethereum as well. It's one of only a couple companies, frankly, that I would want to go work at as an academic. It's very much true to crypto's original kind of ideals of providing users full control of their private keys as a non-custodial wallet. And blockchain's been a huge supporter of academics like myself, has provided grants, major grants to other academic institutions. But there is a big difference as a researcher today, being on the outside of the industry, trying to do work at Cambridge or the LSE, where at the LSE I still actually have a small position, versus being in the industry. It's just like in artificial intelligence. If you want to do cutting-edge AI work today, it's not going to happen inside academia. You've got to go into companies like Google, Apple, Facebook, et cetera. Same thing, I think, for blockchain researchers as well. So very happy to be at Blockchain, and I want to share with you some research that we've been doing over the past year. And I'll start with a quote from my friend here, Augustin Carstens, who's the general manager at the Bank of International Settlements. The BIS, for those of you who don't know it, likes to describe itself as the central bank for all the world's central banks. I think that's a bit of an inflated view, frankly, of what the BIS is today. The BIS is really a research arm for other central banks and a body that helps central banks coordinate policy. But Augustin had this message for all you young people out there in the audience. Quit trying to create money. Young people need to quit trying to create money. You need to leave the creating to money to people like me, the old people. Right? I don't know what exactly qualifies as a young person in Augustin's mind. But the thing is with this quote, I think a lot of people read this and they thought, oh, the BIS and Augustin here are talking about Bitcoin, or they're talking about things like, Ethereum, or they're talking about Zcash or something. And I don't think that's what they are really focused on at all. He didn't say which cryptocurrency we should stop trying to create. But I think what he was really talking about were stablecoins. And we published a major report on stablecoins a few months back. I'm going to share a little bit from the report with you. But the reason why I think his comment is more directed at stablecoins than, say, something like Bitcoin is because central banks have really looked at Bitcoin and they're not too worried about it. All right? It's not something that really threatens their ability to conduct monetary policy. It's, something like Bitcoin can almost be viewed as a collectible. The central bank doesn't care when a Leonardo da Vinci piece of art, like the supposed newly found portrait of Christ, when that sells for $500 million. They don't care about the price of a da Vinci, all right, because it's an asset. It's an asset. And if Bitcoin is a crypto asset, if it's a store of value primarily, that's not something that's so bothersome to what a central bank does on a day-to-day basis. It's just another asset, like a car, like a piece of art, like a house, and so on. What central banks are primarily concerned with is monetary policy and being able to manage monetary policy. And so something like a stablecoin, I would argue, is much more threatening. We're a little off-center here. I don't know if there's a way to adjust that. Let me see if we can do this manually here. It's a PDF, yeah, so is there a way? Excellent. Okay. So cryptocurrencies like Bitcoin, as you know, are notoriously volatile. Stablecoins were invented to try to address, this volatility. For those who don't know what a stablecoin is, basically it's a cryptocurrency, so programmable, just like Ether, just like Bitcoin, but it has a mechanism that tries to keep the price stable. Okay? And they basically have worked. This here, this little line there, is the exchange rate of Tether over a year and a half, roughly, And you can see it basically slightly varied around the $1 peg that it's set to. One tether is supposed to be equal to $1. Stablecoins kind of work. At least some stablecoins do. And this is actually potentially threatening to a central bank in a way that Bitcoin is not, because it's so volatile. All right? There are different types of stablecoins. We don't have too much time, unfortunately, to get too deep in the weeds, but basically you can think of the world as having, the world of stablecoins as being divided into two. There are ones that are asset-backed, and all of this is in the report you can freely download from blockchain.com, by the way. But you've got the world of asset-backed stablecoins like Tether that hold US dollars in banks and let a digital token represent that US dollar. And then you've got things like Make or Die, which are programmable, more algorithmic in nature, and many more, even more advanced designs, that some of which have yet to launch, and some which may never launch, like Basis, that are fully algorithmic and don't have any backing. So you've got your asset-backed, traditional asset-backed, and your more programmatic algorithmic stablecoins. And today, the world of stablecoins is largely dominated by these, some would argue, rather boring Tether-like stablecoins that have assets behind them. Okay, and venture capital, interestingly, has primarily gone into these more boring asset-backed with fiat currencies behind them stablecoins, not into the sexier algorithmic or crypto collateralized stablecoins. Most of the money is going into boring things like Paxos Standard or USD Coin, which is a project of Circle and Coinbase and so on. And the venture capitalists that are putting money into stablecoins, they're betting on multiple stablecoins. And the key takeaway here is that the VCs don't know which of these designs is going to win. So they're spreading their bets across different teams and different designs. A lot of uncertainty around which stablecoin might actually win, but the opportunity is huge because a stablecoin can be used as a substitute for a US dollar, or any other stable asset. The problem with stablecoins today, at least for some of the more, some of the people who are more interested in decentralization, is that today there appears to be a fundamental trade-off between the confidence and the stability mechanism, how stable a stablecoin is likely to be, and its decentralization. The higher the decentralization, the less confidence we have in its stability. The more confidence we have in its stability, the less decentralized it is, right? And we've seen that with Tether, running into lots of problems. Very centralized. It appears they were able to actually borrow. Bitfinex was able to borrow cash from Tether temporarily without informing people. Not something that can easily happen when everything's on chain. Everything's on, a public blockchain that can be audited by users. So that trade-off needs to be reconciled really for stablecoins to fulfill their massive crypto potential. And it's unclear if that trade-off ever will be rectified, I might add. It's a very challenging problem. So that's all the time I have to say about stablecoins. Please read the 140-page report. Lots of great data in the report on over 50 different stablecoin projects, the trade-offs of different designs, how they're being used, what you can use a stablecoin for things like smart insurance, smart escrow, and so on. I just want to briefly touch on some highlights from a forthcoming investment outlook and thesis we put together at Blockchain. We wanted to take stock here 10 years after Bitcoin's invention of where crypto adoption is and what the outlook is for crypto. 10 years, that's incredible, right? 10 years, we've gone from 0 to tens of millions of users. That's, more significant adoption than TCP/IP, the founding protocol of the internet saw. It took 20 years for TCP/IP, I believe, to get the same level of users as cryptocurrency has in 10 years. So that's pretty cool, pretty impressive, right? But billions of people still don't own crypto. Why not? How many people here in the room own a little bit of cryptocurrency? Okay. I'm talking to the converted here. Most of the people out there don't. Why not? Well, lack of awareness is not the problem. All right, we've seen surveys come back from the Federal Reserve, from the Bank of Canada, so not every market has had this survey done, but roughly 85% of Canadians, 85% of Americans, the same percentage, have heard of Bitcoin. So people have heard about it, right? So why don't more people own cryptocurrency. At conferences like this, we tend to focus on these types of challenges, these types of problems. These are what I would argue are the 5 great, outstanding, grand challenges that are internal to the blockchain industry, to cryptocurrency enthusiasts that remain. We talk about scalability. We need to make blockchains that can handle tens of thousands or millions of transactions per second so they can accommodate the Internet of Things. We talk about governance. We talk about fungibility or privacy, the fact that things like Bitcoin aren't great to use if you're trying to remain private. And by the way, as you don't have to be a criminal to have an interest in privacy, although certainly some bad guys do. User experience is a huge problem with cryptocurrency today. That's another one of the 5 great challenges that remains. And monetary policy. This is something that stablecoins are trying to chip away at. What is the right supply for something like Bitcoin? What is the right supply for something like a stablecoin? Does Bitcoin have it nailed? The Bank of International Settlements put out a paper earlier this year saying that Bitcoin was doomed because of its flawed monetary policy. That at some point in the future, as the mining reward gets decreased, that the system won't have the right incentives in place to remain secure. I've got an article coming out in MIT Tech Review challenging the BIS's view because it's just frankly, at the end of the day, the industry will come together and subsidize Bitcoin security if necessary. Just like today, the industry subsidizes core development. Companies like mine, Blockchain, we hire a core developer. We pay for one of the Bitcoin core developers to do work on the core protocol. You'll see companies that are making billions in trading revenue spend the few $100 million I estimate per year to maintain the current level of security that Bitcoin's blockchain has today, if they need to, because economically it makes sense, right? But these are the 5 kind of internal challenges, right? I don't think this is the reason, I don't think these are the reasons, maybe user experience. I don't think these are the reasons necessarily, though, that most of the people out there who don't own crypto don't yet own crypto. The Fed survey, the New York Fed survey, came back and said after, people, they asked them, why don't you own crypto? The number one reason people who don't own crypto gave was that it's a bad investment. The opposite of the reason that probably many of you would give for owning crypto. It's a good investment, or at least I hope you got in at the right time. But after bad investment, people said, well, I don't trust crypto. That's the second most common reason why people don't own crypto yet. And we know about, the bad guys, right, who are using crypto for ransomware. I don't know that trust is just about this or dark web markets. I think some of the trust or the lack of trust in cryptocurrency has to do with inertia and the complexity of cryptocurrency. This comes back to user experience, I guess, but, people get a bank account and they keep it for the rest of their life. And that's the devil they know. And the devil they know is better than the devil they don't. They don't quite understand cryptocurrency. So huge problems and challenges around education, right? The third reason that New York Fed survey respondents gave for why they do not yet own crypto is they don't need it. All right, so first reason is bad investment. Second reason, don't trust it. Third reason, don't need it. And who really needs cryptocurrency today? Now, you may have read the New York Times editorial by a Venezuelan who said, Bitcoin saved my family's life. Venezuela is a bit of a edge case, right? Most countries are not Venezuela. Now, there are a very large number of countries that have, in my view, excessive inflation and could benefit from owning hard assets to counteract that excessive inflation. And ironically, I would argue the hardest asset in history is a virtual asset. It's not gold. Gold supply could go up indefinitely. If Elon Musk gets out to Mars and starts mining the asteroid belt out there, supposedly there's gold there, gold's supply could keep increasing into perpetuity. But, Bitcoin's fixed, and it doesn't respond with an increase in supply when the price goes up, unlike gold. So people may find that they do need cryptocurrency more and more as the war on inequality pushes politics further to the extremes. You see more and more fiscal spending occurring, more and more crackdowns on wealth and so on. You may see more need. But right now, most people do not get paid in cryptocurrency, okay? I take my salary in cryptocurrency, but I don't think, does anyone else here take their salary in cryptocurrency? Yeah, one other person, too. So all the hands almost went up with who owns cryptocurrency. 3 of us actually get paid in it. And can you buy anything with your crypto? Yeah, but it's extra steps, right? It's friction, right? So it's not a very convenient currency, right? And this problem is going to continue. Now, I think machines are already getting paid in cryptocurrency, so they've solved this problem. You know, a machine that does work to keep the security of the Bitcoin blockchain, you know, intact, gets paid for that work with cryptocurrency. So there are things that do get paid in mass for their work today. And as the machine-to-machine economy grows, we might see, you know, more economic activity in that machine economy. But for people, we may be lagging behind in terms of needing to use cryptocurrency. The third issue that wasn't covered by the Fed survey, and this is where I'm going to wrap up here shortly, is want. All right? So people think it's a bad investment. People don't trust crypto. They don't need it. You know what? But I think they don't want it. They don't like it. Right? Is Oslo always this warm in April? No. Yeah. You know, we should maybe be, you know, dropping the crypto discussions and talking about climate change. You know, we're going to need all hands on deck here pretty soon. And one of the things I get asked a lot, you know, by the media, it's surprising. It surprised me how much this question came up over the last 24 months, is about the energy consumption of cryptocurrency. All right, I think when you're in the cryptocurrency industry, you don't think about this as much, but the people outside it, millennials who are worried about the planet burning down, the media, that's a big issue. All right, and it causes a distaste and a dislike for cryptocurrency. All right, that may be one of many things. I think people who have been very successful, Wall Street types, institutional investors, you know, look, I think there's a subversive, disruptive element to cryptocurrency that establishment types, institutions do not like. They don't want it. They like the world the way it is, right? So this is a big problem, too, to overcome. You know, I think when you look at questions like the energy consumption of Bitcoin, the fact that Americans consume in 3 days, just with our cars, as much energy as Bitcoin is consumed in 10 years, you know, it starts to put some perspective around how big the impact, the carbon footprint of cryptocurrency is, right? And so we need to tell these stories, but there is concerns there. Just to wrap up, we've been hearing a lot of hype out of Silicon Valley about cryptocurrency and blockchain technology for years. Something big happened last year, very important, that didn't happen in 2014 after the last great bubble. In 2014 and 2015, many of us who were in the space weren't sure if cryptocurrency was going to really recover. You know, we talk about crypto winter, we were looking at crypto ice age or death. We're used to these guys, Jack Dorsey types, you know, Tim Draper telling us that, you know, crypto is going to take over the world. Draper thinks in 5 years, if you're using a fiat currency, you're going to get laughed at, that you'll be considered a dinosaur. I think that's absurd. But what's interesting is the regulators, some of them at least, like Rosti here at the Commodities Futures and Trading Commission in the United States, are starting to use language that sounds like it's coming from Silicon Valley. We are witnessing a modern miracle. These currencies are not going away. That's the key difference that happened last year versus 2014, 2015. There is a recognition that crypto is not going away, and that's huge. That's a big part of the battle, right? So I think crypto adoption personally is inevitable. You know, we're at tens of millions of users. We've achieved a real critical mass kind of beachhead, but a long way to go to billions. Demographics is destiny. Young people don't trust banks. They are interested in buying crypto. They trust new financial services brands. But it's going to take time for this demographics is destiny story to play out, right? Think about the things that could happen to accelerate this inevitable transition. The wants, the needs, the trust issues. All right, thank you.